US response to China's economic influence. A deep dive into trade imbalance and macro forces. The United States and China hold an intertwined role in the global economy, where trade balances and economic shift between the two nations ripple across the world. The widening trade gap between China and the US, amplified by COVID-19 pandemic, has reignited concern of another China shock as China's export expand and domestic demand remains weak. But beyond trade policies and industrial ambition, a macroeconomic view provides crucial insight into the drivers behind these imbalances. Macro factor behind the trade imbalance. IMF's analysis using the G20 model shows the macro forces like change in national savings rate and real interest rates are the driving factors behind these imbalances. In China, the collapse of the property market and low consumer confidence have led to significant domestic saving. This combined with weak demand for import and bolstered China's current account surplus by about 1.5 percentage point. Meanwhile, the US, experiencing a persistent decline in saving, has seen a deterioration in its current account balance nearly 1 percentage point, closely mirroring the data trend since the pandemic. Potential global consequences has China's share in the global economy has expanded. Even modest trade surpluses carry substantial impact worldwide. China's surplus is sustained through increased export and suppressed yuan, creating a domino effect of trade imbalances across other regions. If unchecked, this could lead to more global economic tensions as countries struggle to balance their own trade and currency values. Understanding the micro-level dynamics between the US and China is key to anticipating the next economic shift as trade imbalances widen and into macro forces driving them persist. The impact on global economic stability grows. For the US to effectively address these economic challenges,